All right, sounds like we are good to go. It's 8 a.m. here in New York, and so today's webinar will focus on the fundamental picture, the macroeconomic picture behind the euro dollar. And I will talk a little bit about myself first, but before we get underway, I'm sure I should say a disclaimer. Thank you, Maud. We are very excited to be here for this monthly webinar at FX Street. And we hope that you guys definitely get something out of this presentation from both of us. So before we get underway, I should just read out this disclaimer that any information and opinions contained in this webinar are for educational purposes only and do not constitute trading recommendations or advice. Forex trading involves a substantial risk of loss and may not be suitable for all investors. So before we get underway, let me just tell you guys a little bit about myself. Some of you may know me from live coverage events at FX Street, but this is actually my first webinar here. And so for the people that may have not seen my face before, I am the Chief Market Analyst at fxtimes.com. And I am joined, and you will be hearing later from my partner, the Chief Technical Strategist, Van Yang. And I like to call myself an economist. I am the Chief Market Analyst, so I do follow the markets more from a fundamental perspective, more so from the technical view. So that'll be the second half of this 3-hour webinar. The first half will focus primarily on the fundamental factors behind the euro dollar and especially the U.S. economy. We're going to talk a lot about a lot of things, so I'm very excited to start. So let me tell you just a little bit about fxtimes.com. On the site, we try to provide news on Forex, but we also try to provide a lot of dynamic content, including videos. We do live webinars. Fan hosts 2 live webinars per week. One is a look at the technical analysis, the current outlook of the markets. Another one is more a training power course where we go over educational materials. We also do live coverage events, Mondays and Fridays, talking about the upcoming week, as well as recapping the week for our FX Times viewers. And so that's a little bit about fxtimes.com. A little bit about myself. I was born in the Ukraine. I moved to the U.S. when I was around 8, grew up in New York City. I'm a graduate of the University of Michigan with degrees in economics and political science. I've always been very interested in international affairs, in different countries and different governments, how they govern themselves, but also their economic policies. And after I got out of college, it just so happened that I found the Forex market, which was sort of the financial equivalent of everything I sort of liked from the political side in terms of international relations. So for 5 years, I was the head currency analyst at CMS Forex, which is a Forex broker, and they provided analysis and news and education to the clients there. So, okay, that's a little bit about myself. Now let's move on to the topic at hand. Oh, I see we have a Michigan fan. All right, Paul Volcker. But yes, go blue. Okay, so what is the purpose of today's webinar? And what I want to do here is dissect the key macroeconomic factors, mainly for the U.S., but we will get into a bit for the Eurozone as well, as that is the second half of the coin in the euro-dollar equation. For the most part, I want this to act as a fundamental primer for anybody who maybe follows fundamental news passively. You see the headlines, but you might not dig very deeply into the individual macroeconomic indicators. Also, I do want to give a little bit of a pretty much history lesson in terms of monetary policy, where we came from, and how that can help us to decide or to analyze and anticipate where we might go in the future. So for the people who are already very adept at fundamental analysis, this might be more a refresher for you, but it's still good to hear some of these things again, and maybe you'll pick up some tidbits that you may not have already known. But for everybody else, especially those maybe more heavily focused on technical analysis, I think this will be a really great course, a really good webinar in terms of being able to look at the broad themes and then pretty much laying out what to look out for in the next quarter, in the next 2 quarters. So what are the factors that we're going to discuss? I do want to talk a lot about quantitative easing and the Fed and the federal and the FOMC policy. We did have the Fed talk yesterday, and so we're going to get into a lot of why the Fed is doing what it's doing and pretty much where we are now in terms of policy, where we could be heading, and what to look out for as we go there. I also want to go over the Non-Farm Payroll report, especially taking a look at some very key releases along the way that helped shape how the euro-dollar performed over the past pretty much 2 years, and also, how we can look at the Non-Farm Payroll report in our analysis for the next quarter. I also then want to examine a lot of the recent U.S. data, which has been pointing to stronger growth in the U.S. economy, and that'll give us that'll help us to explain why we do have sort of the optimism right now about the U.S. momentum in the U.S. recovery picking up steam. Okay, so after we go through those three factors, those are mainly focused on the U.S., we're going to turn to Europe, go into the details of the sovereign debt crisis and the latest developments there. So that's a really big theme in the last 2 weeks. So we're going to sort of, that'll be the tail end of the webinar, and then we're going to sort of put all the pieces together and ask the questions about the euro dollar that we want. All right, so let me actually start by bringing up a chart of the euro dollar. Let's take a quick look at context, and then we'll go through and actually look and break down these macroeconomic factors. My chart of the euro dollar, we're looking at the daily time frame right now, and we're starting pretty much following the financial crisis in late 2008. Where we had the euro dollar plunging from its highs near 1.60, thank you, Harley, down to 1.25. So during this time, of course, we had the meltdown in financial markets, and we had the flight to safety to the U.S. dollar because everybody pretty much wanted the safety of U.S. treasuries at this point. But at the same time, we had very precipitous slides in global stock markets. Of course, it was just a very bad situation all around for financial markets. Now, we did come to the end of 2008, and during this time was the first time sort of response by the Fed to all this was, of course, to slash interest rates. So actually, let me very quickly jump back to PowerPoint. So hopefully, when I go back and forth like this, it still comes up rather well. So as we can see, we had actually interest rates were climbing throughout most of 2005, 2006, and this is actually what sort of caused the problems in the housing market in the U.S., and that once these interest rates kept going up, all the people who took out very low variable interest rate mortgages wound up seeing that their mortgage rates went up and pretty much were unable to pay their mortgages. We had a lot of defaults, and this is when we had the beginning of this subprime mortgage crisis that then moved to the financial market. Following the financial crisis, or actually during that time, we do see as the U.S. economy showed strains, we see that the Fed slashed rates. We were at around 5.25%, and we moved all the way, they slashed rates pretty strongly into the first part of 2008. We held for a little while, and then following the collapse of Lehman, we had dropped from 2% all the way down to near zero interest rate policy. Well, I do have some comment here. That's not exactly what caused the subprime crisis. Interest rates have been much higher in the past. That is very true, RCOX. And it is a very simplified sort of version, but I just wanted to give a very broad overview in a way. But yeah, it's obviously much more complex than that in terms of what caused this subprime mortgage crisis. But at the same time, this bump in interest rates did have an impact. Okay, let me go back to the chart, please. Yes, we are going to talk a bit about leveraging and how we had a lot of debt in both in households, companies, and then actually moving to the U.S. taxpayer following bailouts and all that. So we're going to get a little bit more into that story as we go. So now we're looking back at the graph of the euro dollar, and we see that following the slide to 1.25, and we had a first move and our first foray into the Treasury's sort of extraordinary conditions and extraordinary measures in order to sort of help stop the slide in the financial markets. The first announcement came at around in the middle of November of 2009, where the Fed said that it would buy around $600 billion in mortgage-backed securities. And why did it do that was because let's head back to the PowerPoint. We announced that 600 billion and as well as a program to buy back 200 billion of other securities. So mortgage-backed securities are those securities where we have pretty much backed by mortgages. So putting together all these different mortgage loans and debt and putting it together into securities, and these had been underperforming. And during the slide in the financial crisis, it was very hard to put a price to these mortgage-backed securities, and since they were on the bank's balance sheets, it caused a seizure in the credit crisis, in the credit markets. So pretty much what the Fed said is we're going to try to buy back some of these sort of toxic assets from the banks, which would help free them up to be able to give them, just taking a look at this commentary here, and yeah, this getting to the root cause of the financial crisis is sometimes depends on your point of view, but I think there was definitely a lot of blame to go around overall. But it's good to see how the story unfolded in the aftermath. So the Fed announces this program in November 2008, and then in March 2009 comes back to say that it needs to buy another 700 billion for mortgage-backed securities, as well as 300 billion in longer-term treasuries, which for me is sort of the official start of quantitative easing, and that is when the Fed goes out and actually buys longer-term treasuries. Okay, so yet again, let's just hop back to the euro-dollar pair. I just want to be able to give you guys all the context as we go along in this sort of narrative of what happened with the euro-dollar pair. So this was our first announcement in the middle of November. We actually saw the euro-dollar surge following that, but as stock markets around the world continued to falter, we still had this move towards safety and towards the US dollar to start 2009 up until pretty much March. And we see here in this blue candle was our announcement for the Fed to go ahead and start buying treasuries as well as more mortgage-backed securities. So this was a boon to a lot of financial companies in the United States in that they were able to sort of get rid of some of these toxic assets, and at the same time, because interest rates were so low, they could borrow at a very cheap rate, and then it pretty much helped them to regain profitability. Now, during this time, because of these policies by the Fed, we had the increase in the banks, in the Fed's balance sheet, and at the same time, we had weak growth, we had job losses during this time. We were still pretty much in the depths of the recession, especially if you looked at stocks, during February of March. And following that, following the announcement of quantitative easing 1, we see a steady, first of all, it sort of helped to stem the slide in financial stocks. We're going to take a look at that in just a second. And for the most part, that's March of 2009 can be said to be the start of the global recovery. And during this time, the trade was very easy, since the interest rates were very low in the U.S. and all these financial institutions now were able to borrow at very low interest rates. What they do is they would borrow in U.S. dollars and then send those assets abroad in search of higher yields. And during this time, the U.S. dollar is pretty much the lowest yield or the lowest interest rate during that time, except for Japan. And so the euro dollar, the euro had the higher interest rate, and in the carry trade where you borrow in U.S. dollars and you buy assets in another country, Europe was actually a pretty good destination. So during this entire rest of 2009, as we had the start of the global recovery and we had the beginning of this quantitative easing, we see the euro gaining against the dollar, rallying all the way to 1.50. So longing the euro or pretty much any other higher yielder during this time was a very sort of, I wouldn't say simple trade, but it was the common trade, the conventional wisdom trade, and for the better part of half a year, you could pretty much long the euro and forget about it. Okay, so that is what happened in the currency markets in regards to following the quantitative easing 1 and what we saw as a result. So let's now take a step back to the slide a little bit, to my PowerPoint. Okay. And let's talk a little bit about the effects of quantitative easing and what is the Fed really trying to accomplish when it does this. Okay, so the effects of quantitative easing, they're varied amount of effects, and some of them are short-term, some of them are long-term, some of them are foreseen, some of them are unforeseen. First, let's start with what happens inside of the country, so inside of the U.S., the domestic implications of quantitative easing. So by buying, first of all, like we had talked about, alluded to, by buying mortgage-backed securities, the Fed freed up banks to invest in other assets. The easy trade for U.S. financial institutions during this time was to pretty much borrow in low interest rate loans from the U.S. Because of the low interest rate in the country, and then just go ahead and put that money into treasuries. And by buying treasuries, you were able to pretty much make the arbitrage in between how much you had to borrow and how much you were able to get back in return as a yield. At the same time, because the Fed is in the market and buying up treasuries, it increases the price, and so then it makes it because of the price rise, it also increases the return. At the same time, the Fed is also telegraphing that yes, it is going to be buying up treasuries, and so that's sort of a signal to the market for what to do. Now, the next sort of cause of inside of the domestic economy or inside of domestic financial markets as a result of quantitative easing is that, or at least the theory is that you get lower yields for bonds and lower yields for treasuries. So that, for the most part, the Fed is trying to target the 10-year U.S. Treasury, and that is sort of the benchmark rate, and also sort of the rate that's used for mortgages and other instruments. So when these yields fall, for the most part, the interest that someone gets back for buying the bond is smaller. Okay, so that's pretty much the domestic implications. Why does the Fed want there to be lower yields and lower rates for treasuries? And the simple reason is that this is the rate that it costs for companies, households, and anyone looking for a house to borrow money. So when you have lower interest rates, it's easier for if I'm going to buy a house, to be able to go buy a house, if I need to take out a loan to get a car, if I need to take out a loan as a company to make investment in a factory, all of that is cheaper when interest rates are lower. So it tries to stimulate the economy that way by being able to encourage borrowing. It tries to pump up stocks in that investors and financial institutions might look for higher yielding assets, which is actually both domestically and and looking for these higher yields abroad. And we also have banks being able to borrow cheaply and use that money to invest. So this is a very good thing for the financial sector. All right, now what about the effects of quantitative easing internationally? Now, this is probably what all of us are pretty much familiar with, in that it deals with the currencies markets, and that's what we were mostly interested in. And the thing we hear is that quantitative easing, in essence, debases the value of the currency. And in a sense that there's truth to that, even though you're not necessarily printing money, as some people would say that you're just creating money, you're printing money out of thin air. What the Fed is doing is actually increasing the size of its balance sheet, and in essence, it's pushing a button on a computer that says, okay, as the Fed, I now have X more amount of money. I don't believe that it actually translates to an increase in actual by way of the way the financial markets work. It does stimulate the amount of money in circulation as, say, banks sell their mortgage-backed securities, or they wind up selling treasuries to the Fed or in the market, and then they have more money to spend. But for the most part, it's more a the question is the Fed able to actually contract this balance sheet afterwards, once there's a, let's say, pickup in inflation? And so that's the worry. And for the most part, quantitative easing does work to weaken the currency. Now, okay, so we talked about what happens with weaker yields. So I see a question at these interest rates. Why should banks lend? Aren't they getting free money? So it's an interesting question, and for the most part, banks are able to borrow at very low rates. Now, are they going to go out and lend this money, or are they going to go out and perhaps invest this money or chase higher yields somewhere else? So that's sort of that's one of the criticisms of quantitative easing, in that you might not get the results you want. But for the most part, banks have been reluctant to lend, and that has been a problem for the U.S. recovery. Now, banks seem to be lending okay to big companies, but it's small companies that are having trouble. So I would say, Paul, that we are seeing a problem in that banks aren't lending as much, or that also they're looking for the standards that they set in order to give out loans have been improved, in that it's harder to get a loan. But at the same time, the fact that they are getting free money means that it's very easy for them to make money with free money. If you can borrow at near the discount rate, near zero, let's say, or 0.5 from the Fed, and then you can just go and park it in Australia and make 4%, then it's in essence arbitrage, and you're able to make this money. So that is exactly what has been happening in the international realm. With all this cheap money floating around, we are seeing a lot of move. We saw a lot of move towards higher growth areas and places with higher yields, emerging markets like Brazil, India, Southeast Asia, and China. Now, the next very important impact international quantitative easing is that as we have the U.S. dollar sliding, we know that commodities, gold, oil, and others are priced in U.S. dollars. And so if the U.S. dollar is falling as a result of quantitative easing, then we have commodity prices rising. And so during all of 2009 and a lot of 2010, we saw commodity prices going up and up, and we have hit records in a lot of our different commodities. Now, gold was also a very strong performer, as a lot of investors who saw all of this expansion of the bank's balance sheet look at themselves and say, you know what, I'm not really confident about what central banks are doing. They're just printing money, and as they print money, I'm just not trusting fiat currencies at this point. I'm very nervous. I just got burned in the financial crisis. And so a lot of very wealthy investors turned to gold, and so we saw gold pumped up during this time. So with higher commodities, what happens is it creates higher inflation, and more recently, what we heard from some of these emerging markets, Brazil, China, they have a lot of harsh words for what the U.S. is doing, saying Brazil coined the term currency war, and that the U.S. is trying to, quote-unquote, melt down the dollar. So, this has created a lot of tension in the international community, but for the U.S., the Fed, they're trying to do what they think is right for the U.S. economy, and not so much for what they think is right for the global economy. Okay, so let's move on. Actually going a little bit more slower than probably I need to be going, so maybe I'll pick up the pace just a little bit. So what quantitative easing's effects on U.S. stocks? So here we are taking a look at the S&P, and this is taking this week as we continue to push higher. But let's first focus on what we had here following this very sharp slide in the financial markets. This is the financial crisis, October, Lehman Brothers collapsing, the aftermath of that, and then the slide in the beginning of 2009, and right here we have the start of quantitative easing 1 for all intents and purposes. So as we can see, following this free fall, the moves taken by the Federal Reserve, and also by the Treasury, and even by the previous administration in the form of TARP, bailing out Wall Street, and buying back these mortgage-backed securities, and then also trying quantitative easing, pushing down interest rates, buying up longer-term Treasuries, all combined to increase the stock market and give us this first relief rally, but then a bit more of an extended rally in stocks. So for the most part, as much as people or some may question what the Fed did, or say, was this really necessary? Perhaps creative destruction was best at this time. Let certain banks fail. Get rid of the sort of zombie banks. Get rid of the underperforming, underachieving banks. Even big banks, and go from there. So I don't think that would have been the right strategy, considering how the markets were at the time. And I actually give a lot of credit to the Fed and the Treasury for even TARP and for the moves they did with quantitative easing in order to be able to sort of reinflate stock markets and, bring back some semblance of stability and financial stability for, for U.S. psyche. During this time when we had these plunges, it seemed like it close to the end of the world. I'm sure savvy investors were looking at this sharp move down to these very low levels and, were thinking it was a good time to buy. And, at that point, a lot of financial institutions, once we had these, programs in place by the Fed, did just that and went out and bought all these stocks that had been, slashed as a result of this scare and panic. Okay, so the other thing during this time is we've had U.S. companies streamline their efforts. They pretty much fired a lot of workers, which were at the time they didn't need them, in that demand had fallen, and so you just didn't need the same amount of workers anymore. But even after that, companies continued to try to streamline their production, their sales, and for the most part, we saw very lean, very streamlined companies coming out of this recession in the U.S., and we saw profits rising in U.S. companies, and that translated into higher stock prices. Now we're going to move a little bit ahead in the story. We did and we had this move downward in stocks in the summer of 2010, and this was a rough patch in what we now refer to as a rough patch in the U.S. economy, but really during this time, because of the way unemployment figures were looking and other factors, consumer spending, a lot of people were talking about the U.S. heading back to a double-dip recession. And it was during this time that the Fed formulated and gave its intention that it would do a second round of quantitative easing. And following that announcement, we pretty much had a redux of what we had here as stocks were pumped up and we had stocks rally. So we see that sort of happening in the fourth quarter of 2010, and we also had it coinciding with better U.S. data stream. So again, following this very rough patch, we see quantitative easing too, in a way, helping boost stocks yet again. There were some other factors involved here. We're going to get into it a little bit more as we go forward. So we're going so in depth into all this. First off, for anyone who perhaps doesn't follow this very closely, to give you a good fundamental understanding of what's going on, but also if we know why the Fed moved into quantitative easing and what were the factors around it deciding to do quantitative easing, then we can think about what will be the signs that they're looking for in order to get out of quantitative easing, right? And so that when the Fed actually decides to move towards an exit strategy, that's going to be a very important time for the euro-dollar pair. And so that's something we're going to look for in the next few months, and we're going to talk a little bit about what exactly we're going to be looking for. Okay, so as we look at this stock market, so as I said, quantitative easing, we move towards stocks in terms of domestic markets, and in other countries as well, with the global recovery, we had stocks rally. And let me quickly go back to the euro-dollar pair now, and if we continue to see how price action develop, let's kind of ignore this move in favor of the greenback. We're going to talk about it pretty extensively in a little while, but pretty much we had some better data for the U.S. and the sovereign debt crisis emerged Eurozone, and because of that we had moved down to 1.20. Now this was also around what I was describing as the rough patch in the summer, and following that we did have, you see, the rally again in terms of higher yielders following the announcement and pricing in of quantitative easing too. Okay, so I'm getting a little bit ahead of myself. What I wanted to show was, as we had seen stocks rally, we also saw higher yielders of all sorts rally. So I just switched over to the Australian dollar US dollar pair. Aussie US dollar pair. And so here's 2009. Here is the start of quantitative easing 1. And we saw that strong rally in stocks as well as the sort of beginning of the global recovery. And just like we had in the euro dollar, it was very easy to just go ahead and buy the Australian dollar against the US dollar, as interest rates were higher in Aussie. We knew that everyone realized that with the weaker US dollar with quantitative easing, you're going to have higher commodities, and higher commodity prices helps the Australian dollar. So this was sort of a one-way ticket for most of 2009. buy the higher yielder against the US dollar, right? Okay, so back to the euro-dollar pair. So during this time, I had mentioned during the summer of 2010, we had talks of double-dip recession in the U.S., and we also had a bit of a relief rally following the establishment of the rescue fund in the Eurozone. We had the bailout of Greece during this time, and once we had this establishment of that rescue fund, we had a relief rally, and it also coincided with the weak U.S. economy. And during that time, again, we had a very similar dynamic as we had during 2009, what we're looking at 2009, and that was buy the euro, the higher yielder, and sell U.S. dollar. So for September, October, we see sort of this pricing in of quantitative easing too. All right, let's head back to my slides here. Okay, so I didn't actually show this slide, but this was the Fed's balance sheet. So I had talked about how the Fed, in essence, pushes a button, and now it has X amount more dollars to be able to buy treasuries with, or other securities. And so as we can see, throughout 2009 and early part of 2010, we see that the Fed's balance sheet rose close to 2.25 trillion. So about 1.5 trillion increase here. So this is before quantitative easing too. Now, during that rough patch in the summer of 2010, we had on August 10th, pretty much the Fed first signaled that, okay, something needs to be done. The pace of recovery and output in employment has slowed in recent months, and there were some other warning signs about the pace of the recovery. And after some other comments from Bernanke, the market said, okay, they're going to go forward with quantitative easing, and as we had seen, September and October, markets did go ahead and price in quantitative easing too. Now, the thing was, nobody exactly knew how much the Fed was going to allocate towards this second batch of quantitative easing, and the expectations vary between 500 billion and 1 trillion. The problem is for 500 billion, or the lower part of this range, is that some say that it wouldn't have a big enough impact in order to really move the dial in terms of, say, yields on 10-year treasuries. The original intent, in theory, behind the Fed's quantitative easing. So for the upper end, the 1 trillion end, the worry there is how will the Fed be able to rein back in all of this expanded balance sheet once, let's say, inflation picks up. Also, by doing quantitative easing too, does the Fed, in essence, create the foundation for the next asset bubble, the next bubble that may wind up causing instability in the financial market? So from outside the U.S., there was also a lot of concern. By doing this, you're going to, again, debase the U.S. dollar, you're going to make commodities go higher, and you're going to increase inflation, as well as hot money flows to the emerging markets. So we had, again, currency wars and all that talk during the second half of this year. So once we actually came to the moment, November 3rd, we had the Fed announce that it would do 600 billion in long-term treasuries purchases over the next 6 months. So that came out to a pace of around 75 billion per month. If I'm correct, 600 divided by 8, 75 billion a month. But they also said that they would reinvest an additional 250, 300 billion in treasuries from earlier investments. So some of the securities and treasuries that they had bought, treasuries, I think, more so than securities, that they had bought in the first part of quantitative easing one. Once they matured, they would pretty much reinvest these treasuries to so pretty much when I say they let the balance sheet contract, once the treasury matures, pretty much it would come off the balance sheet. But instead, the Fed said, no, we're going to go and reinvest any of these maturing treasuries. So that totaled around $900 billion of extra quantitative easing, and so that actually increases our monthly, say, per month purchases up to about 110 billion per month, right? And so all of this quantitative easing too is expected to be completed by the end of the third quarter of 2011, and for the most part, this announcement met market expectations, perhaps a little bit more so than expected, right? Now, if we head back to the chart, let me just make sure that's the next thing I want to talk about. Okay, so first let's take a quick look at the chart and what happened after that announcement. Right, so here we were pricing in quantitative easing 2. So this is before the announcement, and this is purely on the speculation of quantitative easing 2, and a little bit of still weak data following this summer slump. Right, so we moved up to 1.40 in this pair, and as you can see, we started sort of topping off, moving sideways in the pair, and following the announcement of this quantitative easing 2, which came at around 141, we actually see the pair, look at that, wind up reversing and moving in favor of the greenback. So again, we're going to talk a little bit about this. It's a similar situation to what we had back here, and I'm going to go over that, and it has to do a lot with non-farm payroll report. That's going to be the next part of this webinar. And so during this time, we had some better U.S. data come out, as well as the reemergence of the sovereign debt worries in the Eurozone. So this is when Ireland's yields rose to a point where people started speculating we're going to have another bailout. So we actually had a move towards the U.S. dollar, both on the back of its fundamentals and also on the strength of demand for safe haven. Okay, so it's interesting. This is something that I think a lot of people who perhaps are new to fundamental analysis don't necessarily get the first time, or it takes a while to realize that the market is always anticipating the future, and it's anything and everything that the market participants know about the future gets priced into the current price. So that's why some technicians say, you know what, I don't even need to look at fundamental data. I'm just going to see what happened with price. Here, US dollar is weak. I see this turnaround. I see, break of this support. I see perhaps a divergence in my momentum indicator. And, for me, this is going to switch. The roles are going to switch. For me, I sort of need to know why the fundamental factors are causing this move. Right? So for new people in fundamental analysis, pricing in something is almost more important than the actual release, unless the actual release is very different from what the conventional wisdom was at the time, or what the sort of speculation is at the time. So here, for the most part, quantitative easing 2, we did have some other factors moving towards USD strength here, but for the most part, the move as a result of quantitative easing 2 was done before the actual announcement. So this move from 1.2640 up to 1.40 was the market pricing in quantitative easing 2. And since they were pretty much on the ball in terms of how big the package would be, then after the announcement, we didn't see a deterioration in the US dollar. Now that doesn't mean that this theme, this big story, has gone away. And as we said, the Fed is going to continue to be in the markets till the end of the third quarter of 2011. So that is still going to pressure the U.S. dollar in the longer term, medium term. Okay, so following this move downward, now we had so Ireland yield spike. They were forced to seek a loan rescue deal. We're going to talk a little bit about this at the end of the webinar, following the end of the year, we had pretty flat December. We had a little bit more panic over Eurozone sovereign debt, and then in the last few weeks, we see this relief rally, and that has come about more on the back of Eurozone data, as well as general market sentiment, more so than U.S. fundamentals. But it's still very important to know the underlying U.S. fundamentals, because as we're going to see, just a couple of reports can swing the conventional wisdom and can cause us to have, strong declines following these sort of rallies, right? So this rally is not as big as to what we've seen here, but perhaps if we continue to move higher and get to an overbought situation, and then we, as we're going to go into next, there's certain releases like non-farm payroll that can really flip the script of what the market is expecting. Okay, so let's head back to the slides. So we had the anticipation for quantitative easing 2. We had the figures announced. And now we want to take a quick look at what were the results in terms of U.S. yields. So the stated purpose is to quote unquote bring down yields, correct? And so here we're looking at the 10-year U.S. Treasury yield over the last, I believe this is, let's say, 5 years. Yes, 5 years. So we had come into prior to the financial crisis, interest rates were the yield, on treasuries was around 5%, and we could see the slide during the financial crisis as we had very strong demand for U.S. treasuries. So when you have stronger demand, it makes the price of treasuries go up, but price and yields inversely to each other, so we had yields going down. And so here, during the sort of height of the financial panic, we see this very sharp slide from around 4% in the 10-year yield down to, I think, just a little bit above 2%. So 200 basis points plunging as you know, everyone moved towards safety. Now it's interesting because we had the sort of quote-unquote start of quantitative easing, buying of treasuries happening around this time, let's say somewhere here, and we can see that actually yields moved all the way up to 4%. So isn't the purpose of quantitative easing to make yields go down? Well, that is true, but at the same time, by the Fed saying, oh, I am going to expand my balance sheet by this amount, it creates uncertainty in financial markets. Foreign investors, creditors will take a look at the U.S. fiscal situation. We'll take a look at the added debt that the Fed is taking on and say, I'm kind of nervous about the U.S. now. And during this time, we actually did have some weak auctions in the U.S., and you can see that we had this pretty strong move upwards as we came close to 4% again on yield. So just as we sort of had the explanation earlier that lower yields and lower interest rates help to stimulate the economy, the domestic economy in terms of people able to borrow cheaper, companies being able to borrow cheaper, mortgages are cheaper. This is the opposite effect. As the yield rises, what you have is everything becomes more expensive. And so that has a way of hurting the economy. Right. So we actually see that following the spike to 4%, we did have yields drop back down during the rest of 2009. So quantitative easing, what have you, did have an effect here as we dropped back down to around 2%. Then we actually saw rates move back up to 4%, and here we have the much stronger move back down. Again, this part of this has to do with demand arising for safe haven during the Greek crisis, and then also the weaker U.S. economy during the months of the summer of 2010. And when you have a weak economy, yields tend to fall down as you have, again, increased demand for U.S. treasuries, increased demand for safety, right? And so we had yields were actually relatively low, below 3%, when the Fed said, you know what, we need to continue quantitative easing. Either they saw that yields were going to head back upward and they wanted to dampen that upward pressure, or they believed that, we're going to bring rates down to 2%, perhaps, right? And instead what we saw was this, again, similar to here where we had a spike in yields following quantitative easing 1, we have a similar situation in here where we rallied higher in terms of yields. So part of that was quantitative easing 2, but part of that was also we had two factors. One was we had a bump in U.S. data, and that helped to increase expectations around the U.S. economy. So by having better data, you price in better expectations about U.S. growth, and that increases expectations about inflation. And so when you have higher inflation or expectations of higher inflation, those investors that deal with treasuries want to have a higher yield in order to protect themselves from inflation. And so you had this jump in yield. At the same time, you also had the
tax compromise between President Obama and Democrats and the Republicans in the lame duck session of the last Congress. And there, we pretty much had, in essence, the tax cuts for the wealthiest Americans extended, so that helps to sort of boost up the economy. It's going to create more demand for luxury goods, and that did come to fruition during the holiday shopping season. And also you had some mini stimulus measures there, some extensions of unemployment benefits, so that also helps to make sure that demand doesn't fall off. We also had some other tax credits that were part of the original stimulus extended during that time. So while that's all fine and dandy in terms of being able to help GDP, at the same time, so that's part of the growth expectations, inflation expectations. At the same time, that tax compromise also increases the strain on the U.S. fiscal situation out in the future, because how was this bill passed? Was there, offsetting government spending cuts? And obviously, you're not going to have tax increases if what you just passed was a tax cut. I guess you could do tax increases in certain places and not others, but overall, this tax cut was just another, it was paid for pretty much by putting it on the tab and putting it on the debt of the U.S. So that worries, just like it worried creditors back here, the U.S. fiscal position. That was part of the reason we had this rally. Now, in January, for the most part, yields have been moving downward a little bit, but we remain around this 3.5 range. So it's very important to see what happens with yields next. If we have the U.S. economy continuing to do better and we have inflation rising, then yields may move higher. So there's that for one undercuts what the Fed is trying to do with quantitative easing, but it also, like I mentioned, could increase borrowing costs and dampen some aggregate demand in the economy. Now, on the other hand, higher yields does make U.S. assets more attractive to foreign investors. So if I'm a foreign investor and I'm looking for yields, and back here in 2007, if I could get a 5% yield on by buying a U.S. Treasury, that might seem like a good deal. At 2%, it's not as enticing. And now that when yields move higher here, then we see an increase of demand for U.S. assets. Now, for the most part, that affects our currency pairs, where pretty much the dollar yen is where this affects things the most, because both of them have really low interest rates. So the small change in yields does help. Now, in regards to other countries, for the most part, the U.S. still has a lower yield, and so you find better. So you find better yields abroad, right? Okay, so I do have some questions. Quantitative easing 2 is just for printing money to meet U.S. spending, not like most of talking for unemployment inflation. So quantitative easing. Okay, so we have Jack saying we are going to likely to see quantitative easing 3, and I'm going to take a look at some of the data and what to look forward as we go ahead. Okay, thanks, Boyke. Yes, I guess I'll come back to some questions perhaps at the end, considering I still have a good amount of material. I realize I probably prepared more than I needed to. Okay, so let's talk a little bit about the rationale for quantitative easing too. So that sort of ties into what you're saying, Jack. And during the time of the middle of 2010, the summer, we had very sluggish consumer spending, and businesses were reluctant to hire, as well as the economy was growing at a very slow pace. Right. So as Stan is saying there, we are going to have he's going to cover the euro-dollar pair very extensively from a technical analysis perspective. I'm going to give you my pointers at the end in terms of where I see the pair perhaps going. So let's take a look at U.S. GDP. So let's ignore this bar here, the 2.6%. This is the third quarter growth. But what the Fed was really looking at was following this very sharp contraction during the quote-unquote Great Recession. We had very strong growth here in 2010, 5%. But that was mainly as a result of stimulus spending and also inventory rebuild. So companies that had ran down their inventory during the recession were rebuilding inventories. This was a temporary, very strong growth rate. We had a pretty good growth rate in the first quarter of 2010. This is the fourth quarter of 2009. But then the Fed is looking at this 1.7%, and this is just in order for the pace of the two main factors that it was looking at, employment and inflation. It was just too slow a pace, and that's when we had it come to the decision to go for quantitative easing too, right? And so we have seen, we see that we did have a pickup in the third quarter, 2.6% growth, and expectations now for the fourth quarter is 3.5%, so pretty close to what we had back here. So we'll see, is this sustainable for one, or, is the Fed just helping a temporary situation, helping short term, but then winding up hurting perhaps the economy in the long term if we can't rein in its, if it, let's say, creates a bubble or creates a runaway inflation. Okay, so let's talk a little bit more about the rationale, inflation and employment. I'll try to go a little bit more quickly through these slides. So these were the two main triggers, and we know that because the dual mandate of the Fed is price stability, inflation, and to see full employment. So when it saw low inflation, and so when we see low inflation and high unemployment from the Fed, then that's what made it act. So let's look at these a little bit more closely. Unemployment rate remains stubbornly high, above 9%, close to 10%. Job growth was weak during this time, both in the start of quantitative easing 1 and during quantitative easing 2. And the GDP growth was not strong enough to create the jobs to even keep up with population growth. And also, inflation was so low that the Fed believed deflation was possible, and that's a major concern, deflation, because it creates a negative feedback loop. So I'm just going to take this question real quick. Is this a real figure? And in terms of 5%, and yes, because as I mentioned, the big thing here was the manufacturing sector was very strong. So let's say companies, all across the U.S. during the recession, you have a certain amount of stockpile, and as you have, you're worried about demand. What you do is, as people buy and run down your stockpile, you don't go ahead and repurchase new stock because you're just concerned that if you purchase more, then the people won't come and buy it. Now, this was during, let's say these 3 quarters here. Now, during the fourth quarter of 2009, things were returning a little bit semblance back to normal, and all these companies went hard in terms of inventory accumulation. And so that is what sort of got us this very high GDP. Now, we're talking about the unemployment rate, rationale for quantitative easing 2. We all should be familiar with this look at the U.S. unemployment rate. So here is March of 2009. That is the start of quantitative easing 1, and as you can see, unemployment rate continued to move higher. So this was still during the pretty much the depths of the recession, as we continue to have steep job losses. Now we came to the summer here, and while the unemployment rate was edging down a bit, it wasn't at a pace that was comfortable, or pretty much it was disappointingly slow for the Fed, and that's the language it uses in the FOMC right now. And so around here decided we have to the summer months, the Fed decides we need to move to quantitative easing 2. Now, we did have a move down in the unemployment rate. I want to talk about this a little bit in the last release, but this is sort of more a statistical move down and not an underlying fundamental change in unemployment rate, though perhaps it could be a sign of things to come. Okay, so that was the worry over unemployment, just super high unemployment rate that the Fed sees as very it's just not good for growth. It's not good for the economy, and so it wants to see that unemployment rate come down, and why it acted. Now, in terms of the threat of deflation, I'll try to be very quick here, but for the most part, when you have drops in prices, well, what it does is it makes consumers, you would actually think that, oh, look, prices are cheaper, let me go out and buy something. But what actually happens is, if I think that prices will actually be cheaper in the future, I'll actually spend less as a consumer. So if I'm looking at a car and it's 20,000, and then I think that in a few months it might be 19,000, and then in a few months it might be 18,000, I might as well just wait a little while longer in order to get the cheaper price. So when you have that kind of mentality, lower prices, and at the same time, companies, because there's less demand during a recession, are all cutting their prices at the same time, trying to outcompete each other, and by doing that, they actually lower their own revenue, and with lower revenue and lower demand and lower sales, let's say for a retail company, they wind up having to fire workers, and when you fire workers, there's less wages, so consumers have even less incentive to go out and buy, and it creates this very negative feedback loop. And so that's something that the Fed was really trying to avoid, and perhaps more so than even the unemployment rate picture was the threat of deflation. So, this something happened in Japan, similar happened in Japan, and they wound up having, quote unquote, the lost decade, in that they're pretty much still battling deflation. And so it's just a very unrighteous cycle once you go down this path of deflation. So that is pretty much what the Fed is trying to do with quantitative easing, is jumpstart inflation. So let's take a look at annual consumer prices. Here's our CPI in the U.S. And first, let's take a look at the red line, which is our headline rate. And you see that as prices were rising about 5% annually in the middle of June 2008. And you see this sharp plunge in prices. We moved down to zero change, and then prices turned negative in annual terms. So you see in March of 2009, when the Fed decided to announce quantitative easing 1, prices had moved negative annually. And prices continued to move lower until they found the bottom here, and we rallied a bit, and we actually had the annual rate move above 2%. But the Fed, coming into the summer, was looking at CPI heading back downward again. Now, if we look at the gray bars, we're looking at the core CPI, so we take out food and energy, and we can see that we're at around above 2% back in 2008. We moved below 2% during 2009, and in 2010, the Fed was seeing this core CPI moving down to 1%. So this is below sort of the target rate would be between 1% and 2%, and this is when the Fed says the underlying inflation is dropping. They're looking at this core CPI figure and also core PCE index. So I actually do have that. Core PCE comes from personal income and personal spending figures, and so it's just another measure of inflation. It's actually the more preferred measure of inflation for the Fed. So this actually only goes out to about November, I believe, or December of 2010. So we don't have the last couple of months or the last month of data. But as you can see, the core PCE is the red bars here, and the core CPI is the blue bars, and they pretty much move with each other. But as you can see, this decline in both of them really got the Fed paranoid, and when they decided, okay, we're going to move towards quantitative easing. Let's look at prices and what the Fed is trying to avoid, and what quantitative easing to. Half of the reason for quantitative easing too. So going forward, this is very, and the headline CPI has been turning higher. So continue if commodity prices continue to filter through, better economy. Let's say stores start raising their prices, core prices, then and inflation continues to move upward. That's going to be one of your very important triggers that perhaps there's going to be a big fundamental shift afoot. Right. So, moving forward, we want to see how inflation develops, because we're seeing inflation being a big problem all around the world, even and not just in emerging markets, but also places like the UK, where we see inflation getting ahead of pretty much what the Bank of England really wanted. So, is the Fed going to act a little bit too slow to be able to catch up to inflation if inflation continues to go up? So they didn't have any worry about that in the FOMC statement we had yesterday. They continue to see this downward trend, and that's what they're worried about. Okay, so in terms of the labor market, what is the labor market taking so long to heal? The recoveries are slow from these kinds of recessions. And as someone had mentioned at the top of the program, it's because houses, businesses need to pay down a lot of this debt that they had taken on during the last boom, and this is a process of deleveraging. So perhaps we're halfway through this process, but for the most part, we are seeing U.S. Households saving more, paying down debt. So as a result, we're not seeing the sort of V-shaped recovery that we could see from a recession that was caused perhaps by a central bank raising interest rates trying to cool inflation. So the Great Recession dug a very big hole for the U.S. economy. If we take a look at total payrolls, we could see that at the end of the 2001 recession, we had around 130 million employees in the U.S. And prior to the recession of 2008 and 9, we had moved up about 8 million to 138 million total employees. Now, during the recession, we saw that whole gain in jobs wiped away. So 8 million jobs wiped away, and then we bottomed out at around the turn of 2010s in terms of prices continuing to fall. Right? So we have to make up 8 million jobs for the U.S. economy. It's a very tall order, right? And if we take a look at payrolls, so this is total payrolls. We see that we were, during the depths of the recession, dropping between 600 and 800,000 employees a month. So, just obscene numbers in terms of the number of people losing their jobs. And it was around the turn of 2010 when we saw things turn positive. Now here, there's some skewing of this data because we had a lot of census hiring. So like 400,000 employees hired here. A lot of that was census work. And so this is a little bit of a distorted figure, but even then we have this very poor patch of jobs data, and that is, again, one of those things the Fed was looking at and saying, you know what, we have to go with another round of quantitative easing. Now, the last few months we have seen more positive total non-farm payrolls, and let's take a look at private payrolls, right? So I actually got this off some politician's website, but for the most part we can see that the last 12 months or 12 straight months, we have had positive private payroll growth and 1.3 million jobs created in 2010 there. So we lost 8 million jobs, we created 1.3 million, so we're still in a very large hole, considering we also have new entrants into the labor force every month. And so just to keep up with sort of the with population growth, you need around 100,000 new jobs per month. So we're very far off from being able to claw back those job losses. So if we take a look at the Fed statement from yesterday, we see that the Fed still has the same rationale. The economic recovery is continuing, though at a rate that has been insufficient to bring about a significant improvement in labor market conditions. So despite the sort of positive data that I'm going to sort of have to rush through, that we're going to take a look at in a second, it's not good enough for the Fed. Also, although commodity prices have risen, longer-term inflation expectations remain stable, and measures of underlying inflation have been trending downward. So this is our two key statements on the labor market and inflation, and the Fed just hasn't really budged. In fact, we actually saw a unanimous decision to go forward with a full allotment of quantitative easing too. So currently, this was sort of their statement on monetary policy. Unemployment rate is elevated. Measures of underlying inflation are somewhat low, and committee progress towards objectives has been disappointingly slow. Okay, so that sort of undercuts perhaps, the Fed might be a little bit more optimistic following the U.S. data, and we're gonna see them sort of get a little bit more cheerier about the economy, perhaps try to signal that looser monetary policy won't be here forever, but they avoided that. Okay, so that goes over monetary policy. I see I only actually have about 25 minutes left, so let me jump forward quickly just to cycle through some of the data that we have had in the U.S. and why there's this sort of recent optimism. And then I'm going to get back to the U.S. euro-dollar chart just a little bit. So we had this, we've gone over the inflation and employment as keys to the Fed's thinking on monetary policy, but there is this optimism for the start of 2011 for U.S. growth, and we are seeing key sectors posting strong gains: consumer spending, manufacturing, services, trade, even jobless claims, and like I said, the boost from the compromise for the tax cuts and mini stimulus. So we have a lot of headwinds heading into 2011 for the U.S. economy. So that builds, as I had talked about a little bit before, expectations about economic growth, also increases expectations about inflation, and so we did see higher yields recently in bond markets. And however, context matters for U.S. data in terms of how the U.S. dollar responds, because if taken as a U.S. recovery story, then the U.S. dollar can gain, but during times of, let's say, risk appetite, and if we have a global recovery story, then positive U.S. data actually can undermine the U.S. dollar because the U.S. dollar is being used as a funding currency for carry trade. So we had talked about that. Low interest rates, financial institutions borrowing in low rates and moving that money abroad to higher yielders, right? So let's take a look at some of this data. I'm going to try to kind of rush through this. But hopefully, we still get the points I want to get across. So let's first take a look at retail sales. And if we look at the gray bars, that's the monthly change. And you can see that we did have this December's figures. December, November, October, the fourth quarter. We had first off, this October release was what really got a lot of people excited. And though the cash registers didn't ching as much in November and December, it was still pretty strong growth in terms of retail sales. And we saw the annual rate of retail sales moving sort of trending higher after going downward during this patch in the summer. So here is that rough patch in the summer. Do we see how retail sales sort of plummeted during this time? And so this is one of those data points that the Fed was looking at, and saying to itself, the economy might be in trouble. Let's do something to try to help boost spirits or boost stock market, make people feel more wealthier, etc. So with the fourth quarter, the end of the third quarter as well, we see the U.S. economy picking up in terms of consumer spending. Now, here's a second look at pretty much the same thing, but this is the personal spending report, so not retail sales, but personal spending. This is actually what goes into when we do GDP. The consumption in GDP is taken from personal consumption, not from retail sales. Retail sales make up, I think, about 80% of this figure. And here too, again, we see this strong rise in personal spending. Now, this data is about 1 month behind, so we have November's data. But here too, just look at the annual rate of what they call PCE, personal consumption expenditure, and we see that we continue to move higher. So that is building the optimism in the stock market, in the financial circles, that consumer spending makes up 70% of the U.S. economy. So if that is growing, then U.S. growth should proceed as well. So now let's take a look at consumer confidence. Again, consumer confidence dips during the summer of 2010, but now we've seen this move back upward. So here's retail sales on the top. This is actually see a question, but spending and retail sales come usually after non-farm payroll. Non-farm payrolls, it comes out at the first week of pretty much the first week of the following month, and yeah, so you would have December's, so you would have January's employment data perhaps before you have retail sales. Sorry, I'm a little bit. I believe that's correct, but okay, let me just continue. So consumer spending, we see this sharp jump in consumer spending. So this actually happened, I believe, this week, and we rose all the way up to 60. So this retail sales, these gray bars, pretty much this annual rate of retail sales, right? This red line. So as you can see, consumer spending has rebounded. Oh, right. Thank you. Yes, retail sales are a very key indicator for employment figures in that first it's consumer spending that needs to pick up, demand needs to pick up, companies and firms and stores need to see this increase in demand in retail sales, and then they'll say, okay, I need more workers. So yes, very good point. If we look at retail sales, we have a good look into the future perhaps on what might happen with employment, right? So these are promising signs, but still the actual job gains haven't materialized yet. Okay, so that consumer confidence, we do see consumers a bit more confident, retail sales going up. ISM manufacturing index, so this is part of the story I had mentioned how manufacturing led the recovery, and it was during these months that we had that 5% growth rate as we had the inventory accumulation. But after sort of declining and moving downward, but still staying above the 50% level, separating activity increasing or contracting, we see that in the last 3 months, manufacturing activity has picked up as well. So if we look at industrial production, we can see that industrial production annual rate had actually been declining during the summer, but has flattened out now, and we had a pretty strong reading for December following November, so I think it was 0.8% rise in industrial production. So a pickup there as well, so that's good for the manufacturing sector. The utilization rate in the U.S., so this is how many factories are in use. As you can see, we were at a very low level at the depths of the recession, but we have been steadily climbing higher, moving above, it's like 76% now. So as long as this continues to move higher, that means more and more factories are being put to use. Okay, now while the manufacturing sector was key in the first part of the recovery for the U.S., it seems that services are now starting to take a little bit more of the lead. So our last ISM services index, so for the December period, we moved all the way up to, I believe it was like 56, and as you can see, that's the highest level we've had, since the onset of the recovery, since the onset of the recession and recovery. It might be a record high actually, but this index only goes back about 10 years, right? So if services picks up, that's good because most of the U.S. economy is services based. And we saw the ADP employment change for the month of December really jump out. It was around 330,000 jobs gained, and in that report, we saw the services producing sector rise 270,000. Now, we didn't see that many jobs coming through in the non-farm payroll report, but it was still one of those data points leading to optimism in the U.S. economy. Okay, next we have the Go Business Barometer. So this sort of is a measure of both services and manufacturing. And here too, we saw a very sharp jump in the December period. So these are very key sort of moves. Just recently, December being a very sort of perhaps breakout month for the U.S. recovery. So will we continue to see such high readings? We'll probably fall back a bit, but still, anything above 50 is an expansion in activity. So we're seeing very strong signs in the U.S. economy. Another factor, there's a lot of data coming together, and that is why we have seen this shift in the sort of underlying fundamentals in the U.S. economy, though it hasn't really translated to a shift in monetary policy just yet. So if we look at trade balance, here's trade deficits, the gray bars, and October, November, the 2 out of 3 months in the fourth quarter, we see that the trade balance has been at its lowest levels in almost a year. So the negative trade balance takes away from GDP growth. So this means that trade will be less of a impediment to growth in the fourth quarter. So why we have 3.5% expectations, right? So we see that it's consumer spending, reduction in trade balance, increase in services that's powering the recovery, and the weak points still being housing, which I'm actually not showing here, and the labor market. So talking about the labor market, here we look at jobless claims. This is one of my favorite charts because it tries to give, it's weekly, so it's timely, and it tells the story of what's going on every week with terms of how many workers in the U.S. have to claim jobless benefits. So we had this very high level during the depths of the recession. We came down to this between 430 and 500,000 level during most of 2010. And so jobless claims you see moved sideways, and that is when we had the unemployment rate stuck. And then since then we've seen the jobless claims heading back southward, moving to 2.5-year lows here during I believe this was end of December. So now we had a little bit of increase in volatility, and as Van says, we actually had jobless claims rising to 454,000. So again, it's the labor market that's sort of knocking back the expectations about the U.S. economy. So it's this juxtaposition between better data, but not necessarily job growth. So we need to move below the 400,000 level, perhaps to 385,000, before we start seeing the type of job growth figures, perhaps 150,000 a month. If we get down to between 350 and 375,000, we have not been able to do that yet. Okay, so now we're looking back again at U.S. GDP. So as you can see, a lot of our indicators have been moving higher, and so that is why we are expecting 3.5% growth in the fourth quarter. So okay, and Andre, thank you for that. Seems that might have been some weather in focus weather impacting that jobless claims report. So sometimes you got to look at the 4-week moving average in jobless claims to get a better picture. So this red line is sometimes a better, gets rid of some of the volatility week to week. Okay? Oh wow, okay, so that is a look at the US. Now let me just very quickly head back to my chart here. And I just wanted to take a look back to 2009. So I want to talk a little bit about non-farm payroll, how it's a very important release, and how now that we have we know what we're looking at in terms of the underlying fundamentals, what can one report, or at least one very important report like non-farm payroll, can do to shift expectations. So we look back again, 2009, we had the start of quantitative easing 1, we had this one-way trade, long euros, sell dollar, until we reached the 1.50 area. Then all of a sudden, we came up to the November 2009 non-farm payroll report. And let me just actually go back, and that report it was forecasted to show 111,000 jobs lost in the economy. Actually, let me just take a look at my notes very quickly. So we came in with expectations of 111,000 jobs lost, and this had come after October saw jobs falling 190,000, right? So 190,000 jobs lost in October, expectations for 111,000 jobs lost in November, and instead payrolls fell only 11,000, and then September's and October's figures were revised to show job losses reduced by a total of around 160,000. So this was a very eye-opening report, and the immediate reaction of the market was to help the U.S. dollar, right? So it was one of those moments where the rare moments, because we had the economy sputter afterwards, where people and investors were saying, you know what, perhaps the Fed may start looking towards tightening monetary policy. So as we have comment here, we now at the same time we did have the outbreak in Dubai, and we had some other risk factors that moved demand towards safety of the U.S. dollar. But this, when we moved up to 1.50, even if we did have some risk sentiment impacts, this non-farm payroll report impacted the markets for the next month in terms of the U.S. dollar being stronger and breaking this sort of trend we've had. So I'm sure Fan will take a look at this more intricately, perhaps the setup that we had in this during this time. But once we had this non-farm payroll report, we had this move downward. So then following this move to the 200-period moving average here in the daily, we have the Greek sovereign debt crisis accelerate, and we moved all the way down to 1.20. Okay, so the rest of 2009 now, we talked a lot about now what happened here in terms of the weak, rough patch of news for the U.S. data, and we had, again, pricing in of quantitative easing too. Right? And so we come to this moment where we're at around 1.42, and we come to October of 2010's non-farm payroll report. And here, the expectation forecast was for, sorry, oops, I just want to do this before, okay, so the expectations was for 65,000 gain in jobs, but instead we had 151,000. So this was a different. So when you look at fundamental analysis, when you want to look at the impact of fundamental news, for my purposes, I like to look at news that might impact things for the next few weeks or months. And this is one of those reports that really did it, because the euro dollar had been on the back foot. We have been pricing in quantitative easing too, and following this report, we see the U.S. dollar strengthening. Now, of course, similar to what we had here with Dubai and then with Greece, here was when the yields for Ireland really decided to skyrocket. We had the bank bailouts there failing, and just they were forced to seek a rescue loan deal. And so during that time, we see the U.S. dollar gaining. And so again, this was another moment. So it was right, and coincidentally, this was right after the Fed announced quantitative easing too, and we had this better than expected non-farm payroll report, and everybody looked at themselves and said, hey, do we really need this full allotment of quantitative easing too? Maybe the Fed will scale back this policy as, we start to see more and more positive data showing that the U.S. economy is starting to get its feet and the labor market is improving. Now, the Fed, I guess, was looking a little bit more longer term, and the next non-farm payroll report we came into after this move in favor of the greenback, expectations had been for 143,000 jobs to be gained, and instead we only had 39,000 jobs gained. So this was a report that sort of knocked back the positive sentiment. Again, we have to, kind of filter out the Ireland crisis from here, but whatever positive fundamentals about the labor market that we had in October sort of got taken down a notch once we got this November report. Now, the next report came closer to expectations, but we had 136,000 gain. Forecast was 136,000, but we had 103,000. Now, this was actually weaker than expected, and it also was weaker because we had that ADP employment report that we had looked at where we had 300,000 jobs gained in the month of December, but instead non-farm payroll only picked up 103,000. So these two reports probably are what gave the Fed the idea that labor market is not really there yet in order for us to signal any kind of tighter monetary policy or a pullback in its quantitative easing. And so the last few weeks we've had this rally in the euro dollar. Now the U.S. fundamentals for the most part were put to the side in that, except for the fact that better U.S. growth will be better for the global recovery, and as U.S. stock markets and other markets continue to move higher, and we had some easing of the sovereign debt crisis, we had the euro regaining its step. Now, okay, so that's a little bit quicker than I want to do that, but I want to try to show you how a couple of the conventional wisdom at the time can be very quickly sort of undone if we have a very strong report. So look for inflation reports and look for job reports to move the needle for the euro dollar going forward, because those are going to be the two things that the Fed is looking at. So, we can look at these other indicators to help us predict whether or anticipate whether jobs will be better, but for the most part we need these very important reports to tell us what the Fed is looking for. Personally, I don't, even though the economy is going to be doing better, I don't believe we're going to have the type of job growth that will make the Fed scale back its quantitative easing to policy. And they made that pretty clear yesterday, as they didn't really try to sound optimistic at all. They kind of painted a glass half empty sort of scenario. Okay, so I am running out of time. We have about 5 minutes, so you're going to take a look at this pair from a technical perspective much more closely. Let's see, I wanted to talk a little bit about the sovereign debt crisis. So let me go back to our slideshow. So we had let me just very kind of quickly talk about the latest developments, but maybe we'll have to have FX Street have me back on. I guess I spent a lot of time on the U.S. economy, U.S. factors. But so what we had with the Euro 8 package, and you can see the representation here, these are the amounts allocated following the Greece rescue. And what we're very interested in is this 440 billion that was pledged by Eurozone countries and up to 123 billion pledged by Germany. Then we would have another 60 billion, another 250 billion coming from the EU budget and the IMF. So altogether, it amounts to around 750 billion. But if we take a look at the debt of the what we call the pigs countries, we already had the bailout for Greece at 110 billion. We already had a bailout for Ireland at 85 billion, but the total debt is a bit more than $1 trillion. Now, so some of the options was to perhaps top off, increase the size of this package, and for the most part, Germany refused. So this is, let's say, a couple of months ago, the options on the table, and for the most part, Germany said no to some of these options. Increase the size of the bailout fund, the 440 billion allocated from Eurozone countries. Second, they said, okay, perhaps we can use we can issue euro-wide bonds. So that would mean that the countries that have higher yields would be able to issue bonds with the same type of yields as Germany yields, and so find some kind of middle ground. Germany would mean that they would have to pay a higher borrowing costs. They did not like that idea, so no Eurozone bonds yet. Now what we're hearing is that, so for the most part, after Ireland and after Germany sort of saying that Germany's role in this is, first of all, they might have even helped start the run on Ireland by saying, or Angela Merkel saying that creditors may have to take haircuts in any restructuring of debt, and again said no to expanding the role of the EFSF, said no to Eurobonds. Germany said that it was sufficient, and we had this uneasy status quo following the European summit in December, and the markets just continued to drive down continue to drive up yields on Spain and Portugal, as they believe that these countries had, or at least Portugal, had the same weak growth dynamics, same strained banking sector, and bad debts in the financial sector, and that they would need rescues as well. Here's a quick look at yields on Greek 10-year bonds, so you could see how yields shot up and they needed a rescue. Similar thing with Irish 10-year bonds. We moved above 7% here. It hit as high as 9%, and they had to rescue. So Portugal, which I don't think I have here, their yields are very close to 7%, and so that was the big worry. Let me actually very quickly take a look at Portugal's 10-year yields. So here's a look at Bloomberg's look at yields, and so let's go back for 1 year even. So you can see the 10-year was around below 5%, and recently we've moved as high as 7%. So the fear was once you move above 7%, they're going to have to seek a bailout. That was sort of the cutoff before Ireland and Greece succumbed. And so, you see this very strong move upward. Now, in the last month or so, during January, we did see this easing in the yields, but then, look, the last couple of days, we're seeing yields rise again. So perhaps some of the underlying uncertainty in this sovereign debt crisis is perhaps reemerging in the Eurozone. Okay, so we're pretty much right down to the wire here. I'm just gonna finish off. So I'm just gonna finish off what the conventional wisdom is at the moment. What questions we might want to ask for going forward. So just give me 1 minute before we get to the technical part of the presentation. Okay, so questions for the euro dollar. We need to think about, in order for US dollar strength, we need to have stronger labor data or inflation data, so we've hammered that theme home during this presentation. Now, in order for the US dollar to strengthen from that, it would also help to have uncertainty in sovereign debt or global growth prospects. So perhaps, these notes aren't accurate, but we would have to have perhaps reemergence of sovereign debt fears. We might have to have China deciding to aggressively rein in inflation. So anything that might disturb the global recovery story will help the US dollar. On the other side, euro strength would come if we resolve this sort of more comprehensive question of what to do with the rescue fund, increase its lending capacity in some way to be able to cover more debt. So far, we saw the first bond issue for the Ireland bailout, the bonds that are being sold, have a very good reception. And so, we'll see how this develops over the next week or so. The key is to look at the February European summit, right? We have we have to look at Spain's changes to the banks that they're proposing and whether they're able to meet budget deficit reduction. Now, the main question is going to be going forward again, do we have general risk appetite or risk aversion? If we have general risk appetite, the dollar is going to suffer because it's going to be used as a funding currency in carry trade. And also, one thing to keep an eye on is the ECB is sounding a bit more hawkish on inflation as of late, right? So just my final thoughts here. 2011 is going to start off well. We're going to have global growth looking strong, and the U.S. economy is proving to be one of the driving factors in the global economy. That should help higher yielders at the expense of the U.S. dollar, especially if the FOMC is slow to tighten monetary policy.
Labor markets will thaw only slowly because of the nature of this recession. So again, that goes hand in hand with monetary policy. I have my concerns about European leaders being able to do the right thing. And even if you have, let's say, insurance for your car, if you have an accident, it's still going to hurt. So if we have to have a bailout of Portugal, it's still going to impact the markets very prominently. I liked the US dollar in November and December when we started seeing the fundamental data picking up. I still do, but in the context of risk appetite, I would say the US dollar is not going to be very strong until we have that shift in either inflation or in labor market. So the way I do see a stronger US dollar is sorry, what this last line is supposed to say, even though we have stronger U.S. data, we can have a weaker U.S. dollar in terms of risk appetite. But if risk events come back, sovereign debt, China, other shocks, then I'm going to go back on the U.S. dollar bandwagon. Okay, guys, so thank you very, very much for your patience. I know that was a lot to digest, very heavy on the fundamentals, but if you guys love charts and technical analysis, we're gonna move to the second half of our presentation. So I'm going to let Van take over. Thank you for the opportunity, FX Street, and hopefully, again, next time maybe pack a little less into this presentation. Okay, so I'm going to turn off the mic and camera, and I'm going to move to let Van take over. Thank you very much, guys, and yeah, let's enjoy and see what Van has to say.